Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PAYCHEX INC quarterly report. PAYCHEX Inc. provides a wide range of human capital management (HCM) solutions for small to medium-sized businesses across the United States, Europe, and India. The company's services include payroll processing and tax administration, employee benefits and insurance services, human resources support and compliance retirement solutions, and plan implementation talent management and acquisition services workforce management, and digital marketplace for earned wages financial wellness and voluntary lifestyle benefits property and casualty coverage, including workers' compensation and cybersecurity protection health and benefits coverage, including health, dental, vision, and life insurance. These services are marketed and sold primarily through PAYCHEX's direct sales force. PAYCHEX Inc.'s stock price has dropped by approximately -7.4% over the past year due to several factors. The company's Cone fiscal 2026 earnings report showed a significant rise in expenses, which overshadowed positive revenue and adjusted EPS beats. Additionally, PAYCHEX reported lower than expected sales for its fiscal fourth quarter and provided full-year guidance that fell below consensus estimates. Analysts have also issued mixed ratings, with a reduced consensus rating based on 12 Wall Street analyst ratings. Furthermore, recent insider selling has raised concerns about the company's future prospects and financial flexibility is impacted by a moderate debt-to-equity ratio of 1.1. These factors combine to contribute to PAYCHEX Inc.'s stock price decline. The primary drivers of revenue growth are multifaceted and varied across different segments. Management Solutions experienced a significant increase of 21% due to fees for providing services, while PEO and Insurance Solutions saw a modest 3% rise. Deferred revenue also contributed to growth, increasing by $4.5 million from 2024 to 2025. Additionally, the company's customer relationships, assembled workforce, and growing client base played a role in revenue expansion. On the other hand, the primary drivers of revenue decline are less clear-cut. However, it appears that net income was a significant factor, decreasing by $43.6 million from 2024 to 2025. Furthermore, an increase in accounts receivable and PEO unbilled receivables net also contributed to the decline in revenue. Net income and profit margins. A shift in performance. The financial performance of a company underwent significant changes between 2024 and 2025. Net income decreased by $43.6 million, or 10.2%, from $427.4 million to $383.8 million. This decline was attributed to acquisition-related costs, increased compensation expenses, and PEO direct insurance costs. Profit margins also experienced a downturn. Operating margin dropped by 6.3 percentage points to 35.1% in 2025, while net income margin decreased by 7.4 percentage points to 25%. However, adjusted profit margins showed some stability, with the adjusted operating margin remaining at 40.7% and EBITDA margin increasing by 2.41 percentage points to 61.19%. The reasons behind these changes are multifaceted, but it is clear that the company faced significant challenges in 2025. Despite efforts to maintain profitability through adjustments, the net income and profit margins suffered as a result of increased costs and expenses. The company is generating a significant increase in positive operating cash flow, with a notable jump from $546.1 million in 2024 to $718.4 million in 2025. This substantial growth indicates a strong financial performance, allowing the company to generate more than enough cash to cover its operational expenses and invest in future growth initiatives. The company has experienced a significant change in its debt level and interest expenses. A substantial increase of 617% in interest expense from $9.6 million to $68.2 million between 2024 and 2025 indicates a notable rise in financial obligations. The total liabilities have also increased by $256.3 million, while long-term borrowings rose from $4,948.2 million to $5,084.1 million. These changes suggest that the company's debt level has grown significantly, leading to higher interest expenses. Management's strategy and outlook. The company is focused on enhancing its capabilities in the upmarket segment through strategic acquisitions, such as the recent purchase of PAYCHEX for $4.1 billion. This move aims to expand its suite of AI-driven HCM solutions and drive growth. The management team expects continued growth due to its strong client base, price realization, and product penetration. To achieve this goal, the company will invest in sales, marketing, and leading-edge technology. It will also pursue strategic acquisitions to further expand its offerings. With a strong financial position, boasting $1.7 billion in cash and investments, management is confident that corporate cash flows will support business operations, capital purchases, share repurchases, dividend payments, acquisitions, and debt service for the foreseeable future. Overall, the company's strategy is centered around growth through strategic acquisitions, investment in technology, and expansion of its product offerings to drive long-term success. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has paid dividends in both the current period and 2025, totaling $389.1 million. Secondly, it has engaged in share buybacks, repurchasing a significant number of shares as part of its primary use of cash. That concludes the financial summary for PAYCHEX INC. Feel free to comment below, and I will be happy to answer them when possible.